Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Corn is trading lower ahead of tomorrow's report, which could spell trouble after the USDA WASDE report is released tomorrow. After making a significant low on September 6th, the market has since been declining in a consolidative move, and as we can see, each subsequent low that the market has made has found support up against our 348 level. We've seen a couple times that the market has come through and tested that 348 number, but today in particular we see some strong weakness. And if the market does continue lower, breaking below the previous low of 344 and a quarter, we anticipate a move down to test that 338 number that we've been speaking of could very well be underway. From this vantage point, we can see that volatility-based resistance overhead has been very challenging for this market. And we have that 315-degree mark at 354 as very good resistance. The market has since come down, and we can see where the market came in and made a small bounce. And right now we're getting ready to test support down at the 360-degree mark at 344.5. Again, the market does look weak right now and does not bode well for the potential response to the WASDE report tomorrow. We can also see the narrowing of our volatility-based bands for the market here. And as the market has been coming down, we can see what had been an upward trajectory now is flattening out for volatility-based bands. The tightening of those volatility bands suggests that once the market's finally able to make a significant low, perhaps near the 335 to 338 mark that we've been discussing, that a bounce from those levels may not be very high, and that the market could simply look to retest the 334 number. Upon reaching this area, then, we're then looking at a time factor either somewhere near October 26th to be the area upon which the market finally makes a final low, and from there the market could potentially look to start to trend back up again. We're looking for that end of November timeline to perhaps be that definitive time zone, and from there we can begin to look forward to new price movement for the corn complex. November beans finds itself in an interesting predicament with its most recent high landing on September 22nd. September 22nd was a very important pivotal date as it was the first day of spring, and on our calendar we believe that a turning point could happen near that timeline. If we look at the two shoulders that have been formed, if you move backwards 11 trading days or 15 calendar days, the market formed a reasonable high. And if you march forward 11 trading days or 17 calendar days, we find ourselves with another potential shoulder for this market. Tomorrow's report then is going to be particularly important because now what we're looking at is the potential for the market to make a rundown that tests previous lows near 920. If the market's able to make it above the 983 number, then we're looking at a potential advance that could find some resistance near volatility-based resistance near 992 and potentially near the $10 mark. In the event that the market fails below the 983 mark, then we're looking at a potential test below at 952. And if we break below 952 in the coming days, we do think that there is a high probability of retesting that 920 mark with the potential of reaching down to about 900. The resistance band of 979 and a quarter to 984 continues to be in play. And as the market now is looking to make a move, we can also see that the market found some support today right up against our 1x1 red angle. Just below that red angle is our point of control of 963, and we do believe that a break of 963, or at the very least a close below 963 tomorrow, would be an indication of significance and potential weakness. If we're able to close above that number tomorrow, then a potential for a move upward then is in play. And so tomorrow we're going to be particularly looking at that 963 number for the November contract. After making a decent corrective move to the upside for wheat, wheat is currently making the move to the downside that we've been looking for all along. Over the last 5 to 8 trading days, we can see very well that the market now is very well poised to retest previous lows that set at 422.5. And over the next couple of days, we do anticipate the likelihood of the market coming back to break that 422 low is probable. Upon breaking that number, we do have a downside target ranges somewhere in the neighborhood of 400. And once it gets there, then we're looking for good support to set in. We have a couple time factors coming in for the December wheat contract. October 22nd in particular is where we're looking for the market to potentially make a reasonable low. From there, we can see a bounce, and then we would recalibrate from there. We would like to add that the current wheat contract is making a case for a potential bounce. And part of that is because the market had been oscillating back and forth above our sinusoidal wave on either side, where the distance on top was matching the distance just below. Most recently, the market did extend its furthest distance from that sinusoidal wave when it reached that top near 461. Upon doing so, the market now has bounced on the other side, and a 100% mirror of that move away from that sinusoidal wave lands at 428.25. So what we would then be looking for is the potential for the market to come in and perhaps give us a small bounce tomorrow in the event that the market does find support, and then shortly thereafterwards to resume its downward momentum, at which point we would look for the market to go in and test at a minimum 413 with the potential of coming down to that 400 mark that we spoke of not too long ago. From here, we do anticipate that week would continue in weakness, and again, we're looking at that time factor at the latter part of the month as a potential area for the market to finally find pause. December crude oil continues to move in a fashion consistent with expectations. In our last discussion, we talked about how the $50 mark could very well be a very important level for this contract. Over the last couple trading days, we find that the last two lows that were made were very close to that $50 mark, coming in at $49.44 and at $49.48. The low close for that time horizon was at $49.65. And from there, the market has since been turning back up again and is now back above that key $51 mark that we've long been discussing as a very critical level for this December crude contract. Now that the market has found its way back above this level, if it continues in this fashion and closes above this number this week, we then anticipate that a move that does test the 54.75 could very well once again be in play. And of course, it's going to need to get beyond that 52.80 number that has been previous resistance the last time it tested this level. But as we can see from the movement of the chart overall, this market continues to keep making higher highs and higher lows. After having made its initial key top near the 51 mark, the market came in and gave us a retracement near the $47 mark. It has since moved up from there and finally was able to reach our minimum price objective of 52.80. It's given us now a very small pullback that has since turned back up again, and it does appear, in fact, that the market could very well make a run up to that 54.75 number. Again, this week is going to be very key for crude oil, and we like that 51 number, and we believe that 51 number continues to play a critical role in giving us a vantage point and understanding the potential areas where this market wants to reach. We're not seeing very much by way of change for December cotton. The market has now made its way back inside of our tunnel that we had spoken of before, and simply what we can see is that price is inside of a consolidation. It does appear that the consolidation in which it's in is a bearish one, and what we mean by that is the market here, after having made its initial drop, gave us a first touch on the top side of our tunnel, which we'd call wave 1 of this consolidation, came back down, gave us wave 2 of that consolidation. From there, it bounced up, gave us wave 3, came in, gave us wave 4, and a potential top here at wave 5. Now, markets often will give you 5 to 7 touches inside of a consolidation before resolving itself and coming back out. Right now, it's trading inside of the two most recent extreme touches. So what we would look for now is for the market to break one of these touches. What we're looking at now is the potential for the market to come in, and if it closes either above or below either side of the key tunnel that we've established here, we anticipate that follow through to either side is going to be strong. Right now, we're predisposed to believing that the market looks to make a run to the downside, but this consolidation in which we're in could last for some time before it finally does resolve itself. We'll have a closing look at the US dollar. And to no surprise, after the market made its way up to volatility-based resistance, we find ourselves in the midst of a very reasonable correction over the last 4 trading days. We talked about how it would be important for the market to find support at the 92.90 level, And in the event that the market breaks below here, we could see a small correction perhaps that comes down to test the 91.95 number. In the event that 92.90 does hold, we do like the potential for the market to reach up and finally reach the target near 95. But for now, it sits at a very critical level, and the way in which it responds at this 92.90 number is going to be very important. The corrective advance that we've seen has been textbook, with the market coming off of our key low at the 90-degree mark. It's now made a full 90-degree advance up to the 93.90 mark, and so it's not unusual for this correction to take place. The way in which this market corrects from here is going to tell us a lot more as to whether or not our upside targets are attainable. But from here, we'd simply sit on our hands and wait for the dollar to broadcast for us with its price action the direction in which it will probably take going forward. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next week.